Yeah. In this session, let's look at the third important aspect, which is the income taxes. Just like a detailed understanding in terms of the long-lived assets or in terms of inventories. So this chapter is focusing more from an income tax. What are the various items in the balance sheet and the P&L statement that go as a part of the income tax? Right, so this is where we'll introduce to a term called as deferred tax assets and deferred tax liabilities. We will introduce the term deferred tax assets and deferred tax liabilities, which will be additional items that go into the balance sheet apart from the tax which is shown in the income statement. Now, before we actually start off, there are three things that we have to understand regarding the taxes. See, we are preparing one financial statement which is containing balance sheet, income statement and cash flow statement. That financial statements are prepared based on either GAAP or IFRS kind of standards, and they are primarily from the perspective of stakeholders, or from the perspective of analysts, or from the perspective of shareholders of the company, purely as per the financial reporting standards. Whereas from a company's standpoint, it has to create another set of financial statements from a tax standpoint, which is a tax filing. For filing your taxes, another set of financial statements have to be created, where there are some differences that exist between these financial statements, which are as per GAAP and IFRS, and these financial statements which would be prepared as per IRS, a tax filing system. Typically, even when companies here file up for the tax, there is a specific format in which the numbers have to be filled up. So it's as good as there are two separate financial statements, right? And and these two differ in some important aspects. Forget about GAAP and IFRS. GAAP and IFRS have their own differences, which we have been seeing in some areas, right? So that difference is keeping it aside. The IRS, which is a tax filing scenario, they specify another kind of a format, which differs from both GAAP as well as IFRS in some of the aspects. And because of that, the tax which you show as a part of the GAAP or IFRS framework, you have a EBT, tax, and then we are saying PAT or net income. The tax which you are showing there may be different from tax which you are actually showing as a part of your tax filing, right? Because the entries are different in both of them. The estimates which both of them are talking of are different. So, but the real tax payment is as per IRS. In reality, whatever the tax you are paying is as per IRS, because they are the tax filing system. So whatever the number that comes out as the tax here, that is what has to be really paid. But your financial statement was showing a different number for tax, right? Because of that reason, we are introducing the two terms called deferred tax assets and deferred tax liabilities. That is in a nutshell, the concept of this chapter is only that much. There are two different systems which will determine the tax, right? There are two different sources where you are computing your tax. One is in your financial statements based on are based on your IFRS or GAAP based framework. Second, a similar income statement, a similar balance sheet is filed based on the IRS directions. And these two differ slightly in some of the areas. We'll talk about in which areas there are major differences existing between the two. As I have mentioned, probably one example I'll tell you. US GAAP says R&D expenses have to be expensed itself. We have already discussed that part. Whereas IFRS says, no, you can capitalize it. Sorry, not IFRS. IRS, the tax reporting mechanism says you can capitalize it. So because of that, there is a difference in the tax and all. Profits will change, taxes will change, everything is changing. Or like that, there are a couple of small rules difference, right? Probably we'll discuss about those things, but yeah, depreciation. The GAAP or IFRS was saying 2-3 methods. You can go with a straight line, you can go with a unit of production, you can go with a double declining, blah blah blah. Whereas IRS says, no, you have to go with only an accelerated kind of a method, typically like a double declining kind of a balance method itself. So when you are showing straight line here, whereas there you cannot show straight line, and because of that there will be a difference again. So because of that, but the real tax payment happens through the tax comes out based on your IRS document. But you have to adjust that with your IFRS based tax or GAAP based tax, financial reporting tax. So that difference, whether it could be in some cases it could be higher, in some cases it could be lower also. That difference is what we are showing as a part of deferred tax assets or liabilities. Now let's see each item. Here we have to understand 4 terms to start with. Taxable income as per tax filing. As per tax filing, on what amount you have to pay the tax. On what amount you have to pay the tax as per the tax filing mechanism is what we call as taxable income. Whereas the same amount or the same equivalent in case of financial reporting is actually what we call as PBT. When we go with a financial P&L statement of a financial reporting, pre-tax income on which tax will be applied. These two can be different. So when you are filing a tax filing system, whatever the PBT that comes is actually called as taxable income. Whereas as per the IFRS or GAAP framework, whatever the PBT that comes, that is what we call as an accounting profit. So the tax that comes through this mechanism, how much tax you have to pay, is what we call as taxes payable. The tax that comes through this mechanism, we call it as tax expense. The terms you have to be quite comfortable with. So as far as the financial reporting, GAAP or IFRS is concerned, the terms are accounting profit and tax expense. Because we always use the word expense. So expense is accounting profit and the expense. Whereas the same things in a IRS framework, we call them as taxable income and taxes payable. So what is the real tax that you have to pay? The real tax that you have to pay is taxes payable, right? It may be different from your income tax expense. It may be higher in some years, it may be lower in some years, right? It may be higher in some period, it may be lower in some period, and that adjustment is what will go into two terms called deferred tax assets and deferred tax liabilities. It's not that you have not paid the tax, because you have paid the tax as per what has to be paid, but your financial statement is showing something different, right? Just I'll give you a simple example. let's say I'll assume that your sales are 100,000 for 3 years, right? Same 100,000 for 3 years are your revenues. Now, what I'm saying is probably we'll talk about depreciation, a straight line depreciation, which you are showing in your financial reporting. So, what will happen? 25,000 is the depreciation, let's assume, each year for something. Because it's a straight line, it will be constant for all the 3 years. So, let's assume no other cost. So, 75,000 is your profit, right? Profit before our accounting profit is what we'll say. No other, only depreciation. Rest all are zeros. Let's assume. So, this is your accounting profit, which is your profit before tax. Let's assume some 40% on this is your tax. So, as per this, your tax is coming out to 30,000. 40% of this is what you are calling as tax. So, 40% of this, so 30,000 is your tax in each of the 3 years. This is as per your financial statement. This is not the tax what you have to pay. You understand the difference between the two. This is as per your financial statements. 30,000 is the tax for all the 3 years. This is not the amount which you are paying. What you have to pay comes from a tax reporting framework. So there also you will show 10,000 or 100,000 as your revenues for 3 years. Right? Now depreciation. It may say that you have to go only with a double declining balance kind of a method. So just for assuming, what I am doing is, okay, here I am putting 50,000 as the depreciation. Then another some whatever. I mean, I'm not going with the calculations, but the 75,000, let's say I'm putting it like this. The same 75,000, because it has to be a kind of a declining, double declining kind of stuff. So initially I am doing it as 50,000. Then probably what is left is 25,000. 2/3 of that 25,000, probably 17,000. I'm putting some numbers like this. So the same 75,000, here it is allocated uniformly, there it is allocated differently. This is that when I am doing a tax filing, these are what I will put as my income and expenses. So because of that, what comes up here, it says that your profit is only 50, right? Or probably for simplicity purpose, let me make it 20 so that calculations are easier, right? So here my profit is 80 and here my profit is 95, and 40% of the profit is the tax. So as per the first year, my tax should be 20,000.